Hello, everybody. Thanks for joining. We are going to give it another minute here to let some more attendees roll on in. We had very strong pre-registration for this today, so we're expecting a really big crowd. So we'll just give another minute or two, and then we'll kick it off here.
Sounds good.
All right, well, let's get started here. Thanks everybody for joining today. This is webinar talking about the impacts of the election and a few other topics we'll get started off with here in a minute. But yeah, thanks everyone for joining. And we have a great set of industry experts here today to help us discuss a few major things happening in the market, in the world. What's going on right now? A lot of moving parts and pieces here with the election and the markets and conflicts overseas. So we have a lot of topics to discuss. Afterwards, we'll have a recording link available, so that can be shared, and that'll go out later today. And throughout this webinar, certainly ask questions through the question box. I'll be monitoring those as we go, and we'll have a little time at the end as well for questions. But certainly, if you have questions as we go, we'd love to hear them, and we can weave those in as appropriate. We're going to introduce the panel here and give them a few minutes and a little background. We have three esteemed colleagues: Joe Policino from Jefferies, Chris Maloney from Bank of Oklahoma, and Tom McHugh from JVB. And let's start out, Joe. Give us a little bit about you and your firm.
Yeah, thank you, Greg. My name is Joe Policino. I've been at Jefferies since 2016, working on our agency MBS trading desk within our securitized markets group. At Jefferies, we're a primary dealer, and we pride ourselves on our entrepreneurial culture, as we're one of the world's leading full-service investment banking and capital markets firms. I trade agency MBS and work most closely on a team here with Gary Wolf, Jack Donahue, Tyler Wick, Serjan Knežević, and Chris Levins. In my day-to-day, I work most closely with banks, credit unions, and independent originators who are hedging their origination pipeline using TBAs and then selling specified pools to the market. I really appreciate the opportunity to be here today, as it combines two of my interests, both markets and politics, as in a prior life I was a government major and also had the privilege of interning on Capitol Hill. I want to thank Greg and the whole team at Agile for the opportunity to participate in what I hope should be an informative discussion for everyone.
All right, thanks, Joe. See, we have industry experts in a multitude of ways, so that's awesome. Thanks for joining, Joe. Tom, kick us off a little about yourself.
Yeah, no, thanks, Greg, and I appreciate the opportunity to speak to you and the group today. I think it's a timely as ever topic to go through, and we'll get into it here in a second. But a bit about JVB. I started the mortgage group here back in 2010, JVB Financial. Previous to that, my roles were at Morgan Stanley and in Highland Financial Holdings, all focused on agency MBS and also financing. And we started the mortgage group here in 2010. The idea was to really offer capital markets expertise to middle market, what I call community mortgage lenders, and also the larger top tier mortgage lenders in three core strategies and areas, and all of which is really following the mortgage loan life cycle. So the idea of our business was to offer the TBA hedging, obviously, as the point one of our transaction. It's the lifeblood to many of our mortgage issuers as they're hedging out their pipelines or just beginning to do so. And that business has been, our first that we launched, and one of our larger ones today, serving about 198 mortgage issuers, ranging from 2 and 5 million net worth up to the larger folks. Our second line of business in following that loan life cycle is our gestation repo. That's a supplement or something supplemental to warehouse lending for our agency and Ginnie Mae issuers. It's a way in which to reduce cost of financing, also get more market execution or advance rate pricing earlier on in the life of the loan. So that's another piece to it. And finally, our last business is our specified pool trading. We are both active in ARMs and also fixed rates. Brendan Cassane is our focus head trader in fixed rates. Kenny Perchetz, we name him the bond father. He's been around for quite a while in our ARM space, although quite bored of recent. Hopefully that changes. But that's just a little bit about us. So serving, roughly the community of 200 or so mortgage issuers in those three core products.
Awesome, thanks a bunch. And Chris, round out the introductions here. Take it away, Chris.
Good afternoon, everybody. My name is Chris Maloney. I'm the mortgage strategist at BOK Financial Capital Markets. Despite the fact with Bank of Oklahoma, the desk is actually out in Stamford, Connecticut. I've been there about 8 years now. Kurt Suzuki is the head trader. We concentrate on spec pools. We also do a lot of custom pools for Ginnie Mae. We deal with approximately, last I checked, 450 different mortgage originators. My job on a day-to-day basis is working with Salesforce, come up with trade ideas. I also give a lot of speeches and talk to a lot of our clients, home builders, money managers, etc. I've been doing this going on 30 years now. I started out at it was Prudential Securities. I moved to Lehman Brothers after that. The collapse was not my fault. After that, I went to Neuberger Berman, and then with Bloomberg, I was there for about 10 years as the mortgage strategist there, and I've been with BOK for 3 years now. And again, I'd like to thank everyone for inviting me onto the panel.
All right, thanks a bunch. Well, let's dive into the first topic here. Let's talk about the rate cut. So we had a 50 bip rate cut back in September. Really the high end of the expected range, yet we didn't see improvements in mortgage rates. Conversely, we've seen a bit of a decline recently. How should we think about the market reaction and kind of what's ahead of us here? But really was strange to me anyway that we didn't see at least a little bounce down in rates. But what's your thoughts, Tom? Why don't you kick us off on that?
Yeah, sure. So as far as the rate cut, I mean, a lot of the folks had said that they were waiting for 25 and it was surprising the market. I don't think there was much of a surprise. We were in the 50 basis point camp just because it had gone on for so long. And I don't think the Fed had anything to lose by going and stepping up there and making that hawkish kind of position at first, because they have really all the time in the world. I think as to why the rates didn't pop back up, I think right now we're heading into a period that the data that's coming out is showing us that there's a resilient economy out there. And maybe this 50 basis point move, might be tempered to maybe one more cut. There's a lot of back and forth, even in our own camp, about how the next couple of months play out within the November and December Fed meetings. And the data is really right now, it's showing that there's a really resilient market overall. We can't quite say for certain we'd have two more cuts. So I think there's that hesitancy you're seeing in the marketplace that this might not be a continuation, but there might be a pause of some sort. And it's really data dependent. I think a lot of that is what we're seeing today. And it's the volatility that continues. We see it, and we'll talk more about that later in a couple of points. But that's that's our stance right now, is that there's so much volatility, uncertainty with how the data comes in positively. We might not see much more coming, up into the year end.
Joe, Chris, any other thoughts on the rate cut that happened?
Yes, besides looking at a lot of data on a day-to-day basis, I think it's very important for anyone in this industry to look at history as well, economic history. And if you look at the peak of Fed rate hikes, both in his latest tightening cycle and the one leading up to the great financial crisis, the peaks were the same, 5.25%. If you look at the peak seen in the 2018, 2019 tightening cycle, only went as high as 2.25 before the central bank slammed on the brakes. So the peak for both the 2007 and the 2024 hiking cycle, they lasted a little over 1 year. They kept it at the top before they reversed course. While that seen in 2018 and 19, that lasted about 7 months. Now, in contrast, the zero interest rate policy lasted 7 years. From 2009 through the end of 2015, we were on the zero bound, and it lasted another 2 years from 2020 through 2022 for a total of 9 years where the Fed sat on 0% interest rates. Now, this just highlights that with modern central banking, meaning today's Fed, they are far more prone to make credit cheap than they are to make credit tight. Now, this is why investors were so aggressive in pricing in the Fed rate cut path that exceeded that of the FOMC itself. So now at the current time, we have 50 basis points by year end is the forecast of markets, about 100 basis points in 2025. And now this matches what the latest SDP shows. Now, this is actually down from when investors had priced in 100 basis points by year end and about 125 next year. That was only as recently as the end of August. So investors were very aggressive about what they saw the Fed doing. And I think that's a function of how aggressive the Fed's been in easing policy during the QE era. Now, the Fed today they've declared inflation to be a past problem. It's one put to bed. You notice this in late summer, Powell began to refer to inflation using the past tense. It focuses now on the labor market side of the equation. They want to keep the labor market strong. Now, in my opinion, this is not central banking, that's central planning. It's a completely different thing. Now, however, keep in mind the third leg of the Fed's mandate, the one that rarely is ever even mentioned, is to promote moderate long-term interest rates, meaning you help fund the government deficits. This happened with the Federal Reserve right from the get-go back in 1914 through 1918. When the United States got involved in World War I, President Woodrow Wilson turned to the board of the Federal Reserve and said, you will fund these deficits, and if you don't, I will find people that will. And they fell in line. Now, stable prices should always come first. Primary job of the Fed, and Powell was saying that repeatedly up until about 3 or 4 months ago, but that isn't always the case. So the question now is, did the Fed jump the gun on inflation? Did they declare victory too early? It's of interest that since they pivoted back to an easy policy on September 18th with that 50 basis point cut, 10-year yield right now is 50 basis point higher. Partly this is due to the Fed talking down the aggressive rate cut path, which markets have priced in. Partly it's due to continued concerns outside the FOMC that inflation still remains a problem. Just one example, if you look at the University of Michigan, the one-year inflation expectations index is at 2.9%, which is well above PCEs at 2.2% year over year. CPI is at 2.4%. So inflation historically comes in waves. The worst of the 1970s great inflation took place not when Arthur Burns was wrecking the dollar early in the 70s, but when Paul Volcker stepped in to repair the damage. That's when inflation took off again. So over the near term, do I see more Fed rate cuts? 25 to 50 basis points by year end. That sounds like a reasonable forecast. Beyond that, future Fed rate cuts will depend on which way inflation moves. If it moves sideways and not higher, we could see more cuts.
Interesting. And part of that is, the cuts can happen, but the primary secondary spread has been pretty wide lately. So there's some dynamics there that we may have to kind of weed through as we get going forward. Joe, anything else to add on the interest rate side from your perspective?
Yeah, I just think that the move we've seen over the last couple of months is the unwind of the move we saw the months prior to that, right? Going into the summer, we had a strong economy and inflation and the Fed getting closer to their target rate. And over the course of the summer, we were starting to price in a growth slowdown through the market and a more aggressive Fed. And finally, we got that 50 basis point cut in September. And I think the market is realizing the economy is stronger than was anticipated earlier. and potentially re-accelerating going forward, and the Fed may not have to be as aggressive going forward. I still think they go 25. That's what the market thinks right now in November. But I think going forward, as Tom said earlier and Chris said, they'll be data dependent. And I think that data will also include, and we'll get to this earlier, election dependent, meaning there could be some policy implications going forward based on the election results we see in 2 weeks.
All right, sounds good. Let's move on. Thanks for the thoughts and insights on the rate environment. We have some big geopolitical events with a few major conflicts still happening in Europe and the Middle East. It seems like we, would have had a potential, expected flight to quality, but that really hasn't happened. How should we think of the economic and market effects of these ongoing conflicts? Chris, why don't you dive in and help us weed through some of the foreign geopolitical events going on?
Yes, thank you. You look, the economic and the market effects of these wars comes from the fact that they can feed into the dollar's reserve status. I mean, you look at like the British, for example. The British pound used to be the world reserve currency. World War I bankrupted them. They went off the gold standard, and America took the mantle from them. Wars are incredibly expensive from a fiscal point of view. And the United States right now, we're a co-belligerent for both conflicts right now. We're fighting on the side of Israel. We're also fighting on the side of Ukraine. For the latter war alone in Ukraine, the estimated support totals about $175 billion so far that we know of. Israel over the past year, I believe we sent them 15 to 20 billion altogether. Now, this is on top of the $3 to $4 trillion or so that we spent in Afghanistan and Iraq, and we're still in Iraq, by the way. These wars, when combined with out-of-control federal deficits that Congress seems perfectly happy with, they put pressure on the dollar's domestic and international reputation. Now, you don't want to sound all zero heads. Zero heads always talking about the impending end of the dollar's reserve status. I think they're way ahead of things. There is no other currency out there right now that points to the imminent end to the dollar's dominance. Human beings are creatures of habit. And like, for example, even though Nixon, way back in the early 70s, when he cut the last tenuous links that the dollar had with gold that effectively made the entire world monetary system anchorless, that did not see the end of the dollar's dominance. The reasons for this, there are many. You have the immense size of the U.S. economy, the huge size of the U.S. Treasury market. We have relative respect for property in the United States and the relatively better inflation performance of the dollar compared to other currencies. However, the use of the U.S. dollar as a reserve currency for foreign central banks has dropped to its lowest in about a quarter of a century. It's about 58% right now, ex-gold. But if we look back even longer, we see that it dropped to the mid-40% range from the mid-80s through the mid-90s. That happened because global central banks, after the great inflation of the 1970s, they moved into the German Deutschmark, the Japanese yen, and gold. That was because we lost respect for the U.S. dollar. It took over a decade for the U.S. government to reestablish trust in the dollar after that, and its use as a global reserve currency moved back to about 70% by the end of this millennium. Now, since then, a major factor that's resulted in the dollar's decline in its use as a global reserve currency was the introduction of the euro in 1999, and that gave central banks another option, admittedly one that still pales in comparison to the dollar. Another major factor has been the increasing aggressive use of sanctions and kicking countries off the SWIFT system for any foreign regime which has invoked the anger of the U.S. government. That will push these countries, so-called BRIC nations, for one example, and it'll also push our allies as well to seek alternatives to the U.S. dollar, because even our allies will look at that and think, well, we might be friends with the United States today, but what if 5 years we find out we're no longer their friends? So the use of gold, for example, as a global central bank reserve is now about 20% of total reserves. That's up from about 12% a decade ago. So the US dollar is just not what it used to be. As a result of repeated foreign wars, heavy deficit spending, guns and butter, as the saying goes. Now, since the invasion of Iraq in 2003, the US dollar has lost domestically about 75% of its purchasing power. Over the same period, the US Treasury debt has increased by 6 times over, from about 6.5 trillion, I believe it's 36 trillion now. And US deficits have been increasing at an average monthly run rate of almost 9% of GDP since the end of 2019. Slowed down this year to about 6% of GDP. So people notice these things. One of the most eye-opening events for me over the past few years was at the beginning of this year. Both President Biden and Treasury Secretary Yellen were asked on the news if we could afford to fund both the Ukrainian and the Israeli wars. I don't remember President Bush being asked if we could afford to invade both Iraq and Afghanistan. So while both Biden and Yellen, they answered emphatically, yes, we can afford it, the fact the question was even asked should be a warning both for investors in Congress. But, all in all, at the moment, there is no adult supervision over D.C. So, is the dollar about to collapse? I'm not saying that. I would say no. Recall the old saying, there's a lot of ruin in the nation. Plus, there just isn't an alternative out there right now. But again, the dollar is not what it used to be because the fiscal position of the United States is not what it was.
All right, lots to unpack there. Thanks for a lot of that deep analysis and discussion. Joe, Tom, any other thoughts on some of the geopolitical stuff going on?
Yeah, no, I'll definitely respond to some of the things that Chris said, and I agree with some, and I disagree slightly with others. If we had this webinar here 2 years ago today, you can throw out a lot of the same facts and figures, maybe just slightly smaller than what Chris just mentioned. And I could also throw in a few other facts to you. 2 years ago, you could say that the Fed is going to be, in the next 2 years, going through a process where they're shrinking their balance sheet from 9 trillion to 7 trillion. There's going to be an additional trillions in issuance from Treasury due to trillion-dollar deficits that we're running. And we're going to be running a hotter economy that's at or near full employment with real GDP prints around 3%. And inflation still running slightly above where the Fed's target is. And they just cut 50 basis points. Well, the 10-year Treasury yield right now is 4.18. 2 years ago it was 4.18. So all those things that we just said have been true 2 years ago, except just increasing the numbers slightly. And we're still where we are today because I think there is still respect and there's still a need for the dollar as the reserve currency and the need for dollars in the world financial system. So I think I respect a lot of the points Chris is saying, and I also agree that the path we're on is probably unsustainable. And I also say that as someone who believes that the risk reward for treasuries in the intermediate term is probably for yields to go to the upside here. But I still think that we can't lose sight of the fact that all of those facts he just mentioned have come to fruition and probably have become even worse over the last 2 years, yet the 10-year Treasury, which is probably the benchmark for the global financial system, has been unchanged in the last 2 years.
Yeah, just to add to that, and I think, in just a shortened version, because a lot of the points that Chris had made and both Joe had made, I agree with, and in some points not so much, but when it comes down to the listeners and what they're concerned with is volatility, I look at it like deal fatigue when it comes to the concern of volatility of geopolitical impacts on the 10-year. You have, the Israeli war, the Ukraine war, all those conflicts have been going on for years and years, and I don't want to make light of that. They're horrific events in their, both their own respective rights. But until someone else steps into one of those and really becomes a definite threat, I think people are getting used to that news going on. It's not having the deep impact on the 10-year. And not impacting, again, repercussions in the mortgage market. I think volatility, and we'll get into more of this, I'm sure, in a second with the election, the volatility is going to be affecting the 10-year is going to be impacted between now and probably a week after the election, because I don't think it's going to be the next day after that, which we'll talk more on. But I think it's a lot of how we view it as geopolitically. There's just that's just an ongoing issue that the markets have kind of gotten used to in a way. which I hate to say again, but that's kind of our position, in a kind of short and sweet version, how it impacts the mortgage issuer.
Sounds good. Any other comment? Yeah, go ahead.
Yeah, this is Chris Maloney. I just want to add that I agree the fact that the wars almost make no effect on the political outlook anymore. It's almost like background noise at this point. We're so used to it. I mean, even now, the wars really aren't a political issue whatsoever. But again, the problem is you never know. It's impossible to quantify the risk to markets from a war. You never know what's going to happen. You know, in August 1914, the beginning of World War I, all the experts were agreed the war would be over by Christmas. 4 years later, they were still slaughtering each other. So, yeah, it certainly is a risk that, God forbid, the war spreads. But, you know, I'm not saying that they will. I'm just saying that there's a risk there that they can. But bottom line is, as long as we keep funding these wars, it's increasing the deficit.
All right. Any other comments on this topic? Otherwise, we will jump to the next one. Thanks, guys, for those comments. Okay, the big one, the meat of the discussion here. We have a big event happening in a couple weeks. Some say it's bigger than our big event for the mortgage industry next week in Denver, which we'll maybe see many of you guys out at. But obviously the headliner, Harris versus Trump, but there are a lot of important down ticket contests as well. How do you guys see the outcomes of the election, along with who gets control of the House and Senate, impacting the markets? The big question of the day. Joe, why don't you kick us off?
Yeah, thanks, Greg. So right now the markets are currently pricing in a Trump victory at a 60-40 probability versus Harris. I think, well, obviously for a variety of reasons, which I don't think I need to go into, who wins the presidential election obviously matters. I think more of a factor will be what Congress they get with it and whether they get a clean sweep or there's going to be a divided government. And I think that's important as we look forward to what's going to be on the calendar in the year ahead in 2025. DC loves their deadlines. In early January, we're going to have the debt ceiling come up, and we're going to revisit that debate. We're also going to have, at the end of 25, the expiration of the 2017 Tax Cut and Jobs Act, which will see individual tax rates rise unless extended or revised otherwise. So depending on which party controls government and whether we have a divided government or not will dictate the outcomes of these deadlines. So I think the market over the last couple weeks here, in addition to pricing in a reacceleration of growth, is getting in line with this Trump trade and seeing that now that the odds of a Trump sweep where former president wins the election and gets a Republican House and a Republican Senate is now up to 50%, which is a drastic increase in the last couple weeks in the betting markets. So we're seeing that being priced in as well here because I think that's inflationary. I think we'll see a continuation of those tax cuts and an extension and maybe even a lowering, as the former president has alluded to in some of his interviews and campaign speeches. So I think we're seeing that flow through to the Treasury market here with rates going higher, with the curve steepening in a bear steepening mode. And I think that's the big thing going forward. I would expect if we see split government, then that might be the best thing to root for if you're in the mortgage market. And if you're in the Treasury market, want to see a stable Treasury market, as one side may try to use leverage to rein in the other's excesses. I think if Democrats have a Democratic House with a Trump presidency, or Republicans have a control of one chamber versus the other with a Harris presidency, one's going to look to either rein in either through tax increases, Democrats, or spending decreases, Republican side, and use the leverage that they have for those deadlines going forward. So that's what we see here, and I think we're seeing that though manifest in the rate market.
Yeah, no, I agree with that, Joe. And one of the things he mentioned that we're seeing, just for the listeners, volatility has been so extreme. Yesterday was a good example of that. We don't quite know, and this is not a certainty, but just for market color, we saw volatility where there was really no data coming out. And what did that lead us to? As the day ran on, you kind of saw this massive move in the market. What is that? it seems to be its positioning. I mean, that's what the market is talking about, the chatter. It's positioning that one view has been taken over another. It's one or several desks that have taken the view of, hey, this is going to be a clean sweep on this side or the other, and they're preparing accordingly, or they're correcting something that they had on the position. And so what I think that means for the listeners and mortgage issuers are to really to stay true to your hedging pipelines. I think that's another reason to be using MCT and Agile as systems, to be really leveraging that, because you don't want to be sticking out in these kind of times, because you don't know when those positions are going to happen. You don't know when those corrections might happen, because they won't be data dependent. So volatility is going to be remain here for a while. And I think going back to the election, just to back on what Joe said, I totally agree that the elections will be swayed basically if it's one way or the other in a clean sweep fashion. I don't think we don't have a look back on the Harris, but we do have on Biden. But we certainly have one on Trump. I think if the threat and what we have as far as the downside for a Trump win is that what happens with the agencies. I think that was a focus of his before. I think that one will come up again. I think it will be weakened if it's not a clean sweep in the House. I think if he has both, then we have some impacts to worry about and consider. But other than that, we've seen a market was fairly stable in the mortgage space, from 16 to 20. We had a pretty good tail from 19 and 20 in the mortgage market in the run up there. So we know there. But I think without the House, to Joe's point, we're not going to see much of a movement at all. It's going to be much more of the same. We're not going to get a lot more movement there. On the Harris side, on the other hand, you have somebody who's coming in for all of this new housing, incentivized. But then on the other hand, it's a positive. But then who's going to pay for that? So I definitely think it's going to be watchful and clear and important to watch who's going to take those house over, along with the presidency, not just one or the other.
Chris, what are some of your thoughts?
Yeah, I'll start off by saying I agree with Joe in the sense that when you go to bed tonight, pray to God we have a split government. That's probably the best outcome we can hope for here. But and I'll preface what I'm about to say by, look, I've never voted, I never will vote, so I'm equally indifferent to all these candidates. But one of the things I'm asked a lot by clients is, do presidential elections affect how the Fed responds leading up to an election? And if you look at since 1972, there have been 13 presidential elections, and in the 6 months leading up to an election, the Fed has cut 3 times, well, 4 if you include this time. They've hiked 4 times and they've held steady 6 times. So while the Fed is certainly a federal bureaucracy and it has to take into account what the president and Congress wish for it to do, because ultimately Congress is its boss, like all bureaucracies, it has the power to protect itself and fight back. Like you look at the bank wars during the 1830s between President Andrew Jackson and the head of the second American central bank with Nicholas Biddle. Jackson won that war. Then you go to the early 1960s and you have President LBJ throwing the Fed chair, William Martin, up against the wall at his ranch and poking him in the chest and threatening him and trying to get him to cut rates. Martin basically told him to pound sand and didn't. So, but I mean, the American electorate now is evenly split between the two candidates. It seems like a toss-up. The mob is fickle. Who knows which way it's going to go? But the traditional Democratic Republican voting cohorts have started to break down. Trump is polling a lot better among minorities than Republicans usually do, and Harris is getting widespread support from what you call the neocons, for very warlike foreign policy. So despite the polls, we really don't know. It all comes down to Congress. Now, neither candidate seems concerned at all about the deficits. None of them are really talking about it. The Harris camp merely claims they do slightly better than the Trump administration in terms of deficits. People point to a Trump administration making about 7.5 to 8 trillion in deficits. They point to the Harris administration maybe 3 to 4 trillion more in deficits. And judging by history, I would agree with the Harris camp. The Republicans tend to be more fiscally irresponsible than Democrats. Now, a Republican sweep, by meaning they take the presidency, they take Congress as well, you probably see a greater sell-off in long-term U.S. treasuries than if you saw a Democratic sweep. So again, the best markets can really hope for is a split. Now, looking at the housing proposals, now the shortage of single-family housing in this country has become so acute that it's finally, and I started writing about this about 8 years ago, finally politicians have noticed we have a severe problem. Harris has made some housing proposals in her policy statements. She basically involves tax incentives for home builders who work for first-time home buyers, a $25,000 down payment assistance for first-time home buyers, and she also wants to take away tax benefits from any investor with 50 or more single-family rental units. Obviously, she's going after institutional rentals, single-family rental investors. That's just a scapegoat. They are not the problem when it comes to a shortage of housing. Now, if you look at Trump's side, his proposal basically comes down to partly he blames the housing shortage on the wave of illegal immigration we've seen over the past 3 to 4 years, and he pledges to open up federal land for building, tax incentives for first-time home buyers. Now, if you look at like the Democratic platform, Kamala Harris, it's 82 pages long. She mentions the word housing about 6 dozen times. Trump's platform is about 16 pages long, and he mentions housing but 5 times. But there's really nothing they can do from the federal level to get the housing market going again. And we need that. We all deal with mortgages. Without home sales and new home building, our sector will dry up and wither on the vine eventually. But the most important proposal we've seen from the Republican side is he's talking about releasing the GSEs from conservatorship, Fannie Mae and Freddie Mac. What's interesting about the Harris policy paper is that the Democrats are specifically arguing against privatizing Fannie Mae and Freddie Mac. They say it will drive up costs for the American homeowner by about $1,200 a year. Bottom line, I don't think whether you get Trump or whether you get Harris, we're going to see the end of conservatorship. Politics does not work like that. It's been almost 20 years since Fannie and Freddie were explicitly taken over by the federal government. Politics is about power. If you had power essentially over the entire housing finance industry, would you give that up? You can reward your supporters using it. You can punish your enemies using that. Politics does not work on that. I think in 50 years, people who are in graduate school are going to open up their textbooks and say, wow, Fannie and Freddie used to be private. Those days are over and we're not going to see them again.
One of the things mentioned, in the news a lot, widespread deportations. What does that do to inflation? Some of the jobs that, frankly, are very needed. How would that impact the market, the economy going forward, if indeed that becomes a reality?
This is Chris Maloney. I'll do that first. I mean, first off, this is what we call campaign promises. To actually institute a widespread deportation like that, if you ever seen the movie Children of Men, it would probably be a very bloody affair. It would not look good on TV and in the press. So I don't think it's happening. And again, supply creates its own demand. These people, they didn't come over here to not work. They came over here for a better quality of life. And I think at this point, it's water under the bridge, and there's not too much anybody could do about it. If he tries to do something about it, it would have certainly negative political effects and negative economic effects as well.
Yeah, no, I agree with Chris on that too as well. I mean, it seems like this is something that's more of a campaign kind of window dressing and working it up. I can't see that coming to fruition because the optics of that just would be grotesque, I think, in the eyes of the public. So horrible. If it does come to an impasse, I don't think it comes to a head. That would be shocking. But again, I think that it's something that's just more kind of fire on wood on the fire, so to speak. It's what's going on in the political landscape.
I agree with Tom and Chris here. It's it's just overall it's inflationary, right? One, from an optics standpoint, it won't probably happen, but even if it were, that screams inflationary. And going back to my earlier point, that shows that what we've seen from the platforms of both parties, if they were to gain power in both the House and the Senate and the presidency, so a clean sweep, both agendas are inflationary, all else being equal. So that is why a divided government, if you're rooting for a stable inflation and for yields not to run up too harshly to the upside here, divided government is the optimal outcome. Because left unchecked, these agendas scream inflation.
Any other comments, thoughts on what's ahead of us here?
We covered a lot of ground.
We got a lot covered. I see no questions out there, but certainly, yeah, I'll pause. There was one of you guys didn't see which one was speaking.
I was just going to say for next year, in terms of you look at gross and net issuance, I think 2005 will actually be a little better. 2023 and 2024, we're seeing about 1 to 1.1 trillion gross. Net is going to be down this year as well. But that's the lowest number since 2014. But the market has slowly healed itself from everything that happened during QE4 and the lockdowns. And I think we should see probably 1.4 trillion in gross next year, maybe 250 to 300 net. So I think things should look slightly better come next year.
Very good. Very good. All right. Any other closing thoughts or comments? And otherwise, we've reached kind of the end of our prepared items. Give you another minute to have a final comment. Otherwise, we can put a pin in this. Very good. Thanks a ton, you guys. Great information. A lot of topics covered. A lot of great insight. And we'll all be waiting, I think, nationwide, pins and needles for these 2 weeks here. A lot of press, a lot of comments back and forth, a lot of division. So we'll see what happens and how the nation can kind of come back together after this process is all done. With that, I think we're done for the day. Again, a recording link will be out later today, and we can go from there. Thanks for your time, everybody, and we'll see many of you out in Denver.
Excellent.
All right, thank you.
Thanks, Greg.
Thank you, everyone.
Yeah, thanks, Chris. Thanks, Joe.